let's navigate the minefield of these financial markets together. So what it's going to be quizzes, okay? It's a quiz. I'm going to open up a question. First person to hit it will be required to answer, or at least try to answer the question, okay? And I'll be here to offer a few explanations if necessary. If we don't need it, I'll just pass on. We'll go on as we go through this, okay? Everyone happy with that? Now, there's a couple of questions which require bidding. It's like one of those quizzes that you see when we're going to ask you to name several terms or several instruments, several products. And I'm going to ask you to start the bidding. So someone might say, I can name 2. And then another class or another table would say, I can name 4. And then someone else will say, I'll name 6. And whoever gets the highest, you'll be required to try and answer that, okay? That's how we'll do some of those questions. You'll see them, it says start your bidding, all right? Is everyone happy with that? Any questions before we get going? No, all good? Right, okay. So stand by your buzzers. Have them in easy reach, so you're not knocking everyone over to try and get to them, all right? And if you're ready, we're going to go for our first question.
London Interbank offer rates.
Like that. Yeah, that's definitely a mark. That's definitely a mark. London Interbank offered rates. You're quite right. Yeah. It's the rate the banks lend to each other. It's an offering rate. It's a rate where we offer money to each other. Well, that's the idea behind it. It's received some bad press over the last little while, and many banks are fearful of lending to another bank. It's crazy as that sounds, but we unfortunately have lived through an environment where we've seen banks fail on us. So we are a little bit concerned in certain these areas. Next question. Bank of England. Ooh, no, not the Bank of England. You look shocked.
All the banks set it. They all kind of put their offers in.
All the banks set it.
Oh, no, a select few banks.
A select few banks, yeah. There's a
like
kind of.
12 or something.
It depends. Yeah.
Taken out.
Yeah, we have a set amount of quoting banks. Now, it's not going to be just like a tiny little bank, because that's not relevant to what we need to use this rate for. So it's going to be a selection of banks that are able to quote this, and it's worthy of quoting this. Obviously, many of you in the room are members of these quoting panels. But what I was actually looking for is the body that actually sets the rate. The banks submit their versions of the rates, their ideas, but who actually sets the rate? Who officially sets the rate? ICE, yes. Who is the ICE? Can I, for like an extra mark-ish? Intercontinental Exchange, ICE, which appears to have taken over the world of late. It was formerly done by an association called the BBA. That's the British Bankers Association. Unfortunately, with all the LIBOR scandal, with all this talk of rigging and manipulation, the poor old BBA lost their right to do this, and it got passed to ICE. It's actually now known as the IBA, which is the ICE Benchmark Administration Team. There's the guys that actually set these rates, but of course it's in line with all of the banks. The banks submit their quotes. The IBA's job is, of course, to collate those quotes. In fact, let's just have a quick example of how they do it. If we were talking about, for example, and there's 5 currencies that we currently quote on in terms of LIBOR. So it's going to be sterling, dollars, Swiss franc, Japanese yen, and euros. But if I pick sterling, this is how sterling LIBOR would be set. Now, it's going to be done for 7 maturities. What I mean by that is we could be lending money overnight. We could be lending money for a week, maybe for 3 months, maybe for 6 months, maybe for 12 months. It's all under the 12-month period, but we're setting rates that we're willing to, of course, use over these time periods. So if I think about sterling and sterling LIBOR, there are 16 banks that are involved in this process. It does depend on the currency and how many banks are involved in the process. For sterling, it's 16. So let's imagine 16 banks at 11 o'clock every day submitting their quotes into the IBA these days. And those quotes are going to be lined up in descending order. Way back in the day, the original question was, where would you lend money to another one of your fellow banks? That's a difficult question these days because unfortunately we all have different credit ratings. Back then it was all assumed to have a rating of AA. So he said, where would you lend to a bank of the same credit quality as yourselves? That was the original question. So with that in mind, why would you, if you were one of these banks, submit a rate that was very, very high? You've been asked where you would lend money to another bank. Why would you submit it when it's very, very high? Why would you put that in there? What are you trying to tell? If anything, if you were offering a price on something, why would you make your price very, very high in comparison to everyone else? Sorry? You feel like you're valued more? Possibly, but then of course, if we're thinking about a regular marketplace, if you put your price too high, nobody's going to buy it from you. You'll price yourself out of the market, won't you? And hopefully a bank is not looking to price itself out of the banking system. So why would you put a rate in very, very, very high? Discourage lending. Now, we could be doing this for a variety of reasons. It could be the fact that we just don't have money. Perhaps we are in need of money ourselves. We have a deficit in our accounts. Because don't forget, your banks are literally squaring the books up every night and finding out whether we have a deficit or whether we have a surplus. If you have a deficit, you definitely don't want to lend out any more money. So of course, you'd put a rate in very, very high. You don't want to be too far out of the market because that could be embarrassing. Imagine if it was your bank quoting a really, really high rate and everyone was so much lower. It's kind of embarrassing, isn't it? Because it's just like, oh, those guys don't know what they're doing. So we could have that scenario. But generally, we're trying to discourage people, as you quite rightly say, from borrowing from us. And therefore, the inverse would be true. If we put a rate in nice and low, maybe we have a surplus of cash in our accounts and we want to use it. We want it to get to work. We don't want it to just sat there. So we are offering lower rates to encourage people to come to us and not these expensive people up there. Does that make sense? Yeah? So that's what the original style of LIBOR was. Over the last 5, 6, 7 years, when we've gone through all these problems, the kind of question was turned on its head. It wasn't where you would lend money, it's where you could borrow money. Where can you borrow money from another one of your fellow banks? Now think about that as a question. Why would we put a rate in high in that instance? Why would you put the rates up really high? Apart from you telling the market, I'm in trouble. As in, my credit quality is not very good, so if I have to borrow money, I have to pay an extortionately high rate. If I'm putting a rate in very, very low, it's suggesting my credit rating's impeccable, and people are falling over themselves to lend me money. Take my example take me for an example. My bank won't lend me money. My credit quality is terrible, and I'm being charged $2,000. It's a story, of course, but I would be borrowing from them at 2,500% per annum. Okay, we won't talk about how they work their rates, but you get the idea. If your credit quality isn't very good, you're forced to go to all kinds of places to try and borrow money, and probably you're going to be charged very, very high. And that's what, of course, has potentially led to this manipulation. As a bank, you don't want to be putting a rate in very, very high because you're telling the rest of the world you're not very good. You're encouraged to put the rate in very, very low. Now, through all of this, we can see how this rate could be skewed. Yeah, if we put a high rate in, you're pushing the rates up. You put a low rate in, you're pulling the rates down. What the BBA did and what the IBA still do, although they're working on new techniques to do this, they removed the top 4 quotes in the 16 quotes. They remove the top 4, they remove the bottom 4, and they take an average of the remaining 8. And that's how they set LIBOR for these terms. So they're working on a different method because perhaps this is still flawed. It can still be skewed, so they're looking at ways to improve on that. But we'll see how that pans out in the future. Talking of my dear old grandmother again, she's an expert on LIBOR these days. When I talk about it, LIBOR, yeah, it's another reason why you banks are criminals. You know, you're doing all these nasty things and you're ripping us all off. Well, if you think about it, and this is something I'm going to lead into perhaps the next question, it could have done us some good, or some of us some good, with this manipulation, if that is anything I can really logically say. So here's the next question. Why is it relevant? Why do we care about LIBOR? Why do you care about LIBOR? It's just for the banks, right? It's just for the traders and the sales. Why do we care about LIBOR? Why is it important to us? Precisely. It's the rates that trickle down to us as regular human beings. So it's about our credit cards. It's about our loans. It's about our mortgages. It's very personal to us. So yeah, this LIBOR situation has got people stirred up because it does, it's not just the banks, it's not just the traders, it's not just, how we can use our money overnight. It's all about the individuals. It's all about my grandmother as well. Yeah, it's all of these things, these connections, because these rates will filter down to the products that we kind of deal with on a daily basis. Now, on mortgages, if, as has been suggested, the rate has been manipulated lower, that's good news then, right? If your mortgage is based on LIBOR and LIBOR has been artificially lowered, then that's good news for your mortgages, good news for any loans that you could have taken out. So I don't think we've got a big issue there, but what if you're a depositor? What if you're a saver? Because again, this will reflect in your accounts. So these are things we worry about. And that's why, of course, it is relevant. Originally, lots of people came up with the idea, right, something that could be manipulated, it's not something that's real, it's just a reference rate, it could be any old number, let's get rid of it, let's replace it, let's change it for something else. That's not an easy task. There's currently about $350 trillion of products that are valued reference to LIBOR. And we can't just scrap it, we can't just say, oh, that's it, let's end all the agreements. Because where would we be? We'd be caught in those areas. So it is relevant to us, and it's relevant to everyone, all the way down to the people on the street. It really is relevant. Okay? What's a basis point? 100th of a percentage. Yeah, absolutely. So we talk in basis points. It's market terminology, but we can use those kind of expressions when we hear about things like the central bank moving their base rates. Their base rates, where everything's based off. If we think about LIBOR as trickling down to us, well, it all comes out of the central banks, the Fed, the ECB, the Bank of Japan, the Bank of England, of course. Our base rates filter into LIBOR. We try and keep people very close. So when you hear terms like, oh, the central bank has just raised rates by 25 basis points, they mean 1/4%. So rather than move rates in big chunks like whole percentage points, that's why basis points tend to be the terminology we use. Everyone happy with that? Any questions there at all? So you probably hear these terms and, oh, it's just moved up by a couple of basis points. If you're dealing with large sums of money like your banks are doing, every basis point does matter. It's not the percentage points, because that's a huge movement. We look at the minute detail, if you will, the basis point. What is cable? Dollar sterling, yeah, absolutely. Or, may I say, sterling dollar? Now, I'm being picky here because I'm thinking about the FX world. And the FX world always likes to talk about the fixed or base currency first. And that, in this example, is going to be sterling. So they call it sterling to dollar. Now, why do they call it the cable rate? Any ideas? That's it. There's a cable beneath the Atlantic. It's still there, apparently. Don't know if it's people tripping over or anything like that. It was buried beneath the Atlantic, and it's where the original deals were struck between here and New York when we did the original transactions. So it's just a slang term that the FX boys use, cable. Now we use this expression, but others would just say, oh, it's sterling dollar. We don't need the slang terms, but we bring them in there. Perhaps it's all about salary preservation. You know about sterling dollar, I'll call it cable, and you'll think I'm doing something marvelous. But it is literally the exchange rate between sterling and dollars. They originally came up with a term for euro dollars. That's euros to dollars. They called it fiber. Any ideas? Because we didn't use cables anymore, it was all fiber optics. Silly, crazy things. But they're the slang terms we use. So sometimes you hear some of these terms, you think, oh, it must be something magnificent I'm missing out on here. It's not. It's someone's idea of just an expression. It's just a slang term, that's all it is. So that's our cable. On that note, what changes foreign exchange rates? Yeah, interest rates, amongst other things, interest rates. Yeah, because it's going to reflect the strengthening or weakening of currencies. So exchange rates. Exchange rates can be moved by interest rates, can be moved by our transactions. If we start to visit these countries or buy goods from these countries, all of that can change our exchange rates. Absolutely. So essentially, we take it down in the banking world down to interest rates and how, of course, currencies can strengthen and weaken. What do they mean by the terms spot and forward rates? Absolutely. Dealing today is spot, although I will say in the FX world, as with quite a few markets these days, spot means we'll deal today, but we'll actually settle up 2 days, 2 business days from today. So they call that T+2. So we will deal with the rate today. It's a bit like you going into Travelex and saying, I'm going over to Spain, I want some euros, and you deal on the quote that they give you today. And perhaps they'll tell you to come back in a couple of days' time to pick up your money. So the trade will be negotiated today and settled up a couple of days later. That's a spot deal. The forward deal is sometime in the future. Sometime in the future. Now, why don't we call it a spot and future rate then? Because we could be, couldn't we? Again, the expression that we're using here is because we're dealing with something they call an OTC market, an over-the-counter market. An over-the-counter market, that's all it is. So they use the term forward in the over-the-counter markets. If it was on an exchange, we would call it a future. So it's just terms that we switch to talk about various different markets, but they mean the same thing. We're dealing for something in the future, some forward point in time. Okay? So how do we know what the exchange rate will be in the future? Is it that these FX guys are all psychic and they can see into the future and they all sit there in the evenings with these crystal balls and candles and go, oh, is it something to do with that or not? Predictions. That's dangerous though, isn't it? Predictions, just to predict something. That's almost like mind reading, isn't it? It's a bit of a Derren Brown act, isn't it? Oh, I'm going to predict this, and I'm going to predict you will really enjoy this course. You might not think it at the moment, but you're going to really enjoy it. No, it's not necessarily predicting, because that could lead into differences. I might predict one rate, you might predict another, and we will clash. And of course, when we clash, it could cause volatility. But it's not just about prediction. Whenever you hear the term future or forward, it's not about predicting. I think this will be this price in the future, because that's open to so much speculation. It's not just that. It's often the expense of getting us to that point in the future. That's what it's down to. There's maths behind this. I'm going to show you briefly, but it's not something you want to get too hung up on, because this is just the theory behind it. It's something they call interest rate parity. Now, this market is absolutely huge. London contains most of the business because of where we lie in the time zones of the world. We put through on a daily basis about $4 trillion. I mean, it's huge, huge market. I'm not going to deal with sums of money like that because I don't know how many noughts there are in a trillion, so I'm going to keep it nice and simple. Let's imagine, and this is going to be in cable, all right? We're going to use cable again. That's sterling to dollars, of course. Let's imagine the cable rate is $1.5 to each pound. Now, bear that in mind. When I said to you we always talk about the fixed or base currency like sterling, that never moves. It's always £1 sterling. £1 sterling equals $1.5. Tomorrow it might be 1.6. You get the idea. It's always £1. All right, so £1 equals, if I'm going to quote it in the right way, $1.500 to the pounds. Yeah? So that's our cable rate. That's going to be our spot rate. That was the term we just used. Okay, so that's our spot rate. That's our rate today. Let's go to the point of interest rates. And let's say we're told interest rates, whatever that term could mean to us, it's rather vague, but we'll say UK interest rates, we are believing would be 1.5% for the year. Okay, that's our UK interest rates, whatever, again, that term means. Assuming, of course, that we can all use the same rates, which is a whole different argument, but we'll talk about that another day. So UK interest rates, 1.5%. US interest rates, that's the other currency, of course, we'll say are running at 2% per annum. Okay? What we're going to do with that is we're going to calculate what we believe this rate will be in 1 year's time. It's going to be this easy. Well, in theory, it's this easy. All we're going to do is take a small amount of the base currency. Let's take £100. Yeah? Imagine we took £100. I gave you each £100 when you leave the room today, and you wander into your local bank and you put it on deposit. And you're going to put it on deposit at the said interest rate for the year. So this is 1 year later, and you're going to put it down there at a rate of 1.5%. Well, that would give you, again, if my maths is okay this afternoon, I'm pretty sure it is, That would give you £1.50 of interest. Add that to your original sum of money, and you will have a total sum in your bank account in 1 year's time of £101.50. Everyone happy with that? Yeah? Not complicated maths here. Right. How many dollars would my £100 buy at the current rate today? So this is today, and the spot rate is the rate we said was used today. So how much would that be? $150. Okay. So let's imagine we're in New York, and I give you $150, and you wander down to your local bank. You put it under the deposits of 2%. So you're going to put it in your account at 2%. 1 year later, you'll have earned $3 of interest. $3 of interest. And that would give you $153 in a year's time. All good? Now just remind me, how did we get from here to here? We just used the spot rate, didn't we? We took £100 and we multiplied it by the spot rate. And that's what gave us that. So for the future, if we know that we're going to have these sums of money in our accounts, all we're going to do is come back the other way. So all I'm going to do is take my $153 and divide it by £101.50. It's kind of what we did there. If I took $150, divided by the spot rate, I would get £100, correct? So that's all we're going to do here. $153 divided by 101.50, that's going to be, unless again my maths is completely off, that in 1 year's time. That's it. In theory, that's it. Because the idea is we've got to iron out any free opportunities, any risk-free opportunities for making money. So what you're looking at there is where the rate should be. 1.5074 in 1 year's time, based on this scenario. And why so? Because if it didn't move from here, we could take advantage of the difference in the interest rates. What would be to stop us using this nice cheap rate here and borrowing as much money as we possibly could, turn it into dollars using the spot rate, jump on a plane to New York, put it into a bank account at 2%, and earn 50 of those lovely basis points for a year on as much money as we could borrow? Where's the risk? Because the rates are there. So in theory, that's where the rate would be to iron out the interest rate differential. Make sense? So that's how these guys do it. It's a bit more complicated like that than that in reality, but you get the idea. That's what's going on. That's this theoretical pricing that we talk of. So the futures price isn't just predicting where we will be, it's the cost of getting to where we'll be. That's what it's about. So anytime you hear about futures and forwards and talking about forward pricing and all of these things, there is some kind of mathematical formula behind it. And often it's not very complicated. Is everyone okay with that? Good. All right. Right, so that's how we can find it out. A bit more complicated like that in reality. So don't go up to your FX traders and go, I know what you do, and it's simple. And how much are we paying you? Please don't do that, because they'll then tell you the reality of it. Right, let's talk about some shares. What's the difference between an ordinary and a preference share? Right, the main difference between an ordinary share and a preference share, yes, it's kind of in terms of payments, literally the order of payments. So the ordinary shares, which they tend to refer to as common stock over the pond, in the US, these are just the regular shares most of us tend to buy. If you wanted to buy some shares in Vodafone or BP or any of these companies, we tend to buy the ordinary shares. Now the things about the common stock, the ordinary shares, they're quite ordinary. They're quite plain vanilla, if you will. What they do is they pay us a variable payment, and you know, of course, in the world of equities, we tend to refer to this as a dividend. So they're going to give you a cash flow known as a dividend, and that will be based on the profitability of an organization. So if the company is very successful, you might get a lovely dividend 1 year. If they don't have a successful year, you might get a very low dividend, or alternatively, absolutely nothing at all. Because these cash flows are at the discretion of the company itself. So if you buy into these companies, variable amounts. And that's why the pricing can be different, because we just get variable amounts in terms of the common stock. But when you buy into a company, you are literally being a part owner in that company, so you have the right to vote. So you can attend the company meetings when they have them. You can attend them, you're going to go to the AGM, the annual general meeting, and any other general meeting that they call, you can turn up and you can make a vote. You can even vote whether a dividend should be paid or not. All right, the company will suggest the idea and then you can vote whether you think it's a good idea or not. Someone's about to pay you money, you're probably going to vote yes. Yeah? So that's the common stock, the ordinary shares, variable dividends, the right to vote. You are a part owner in the company. So you could be an owner of Vodafone. You could be an owner of BP, an owner of all of these companies that you could. Now the preference shares, otherwise known as preferred stock, you're preferred, as you quite rightly said, in terms of the payment of this dividend. If they are going to pay a dividend, again it's an if they're going to pay a dividend, they've got to pay the dividend here first. And here's another major difference. The cash flow they pay us is fixed. It's a fixed amount. It doesn't change. It's a fixed percentage. It's almost like buying into a bond. It's a fixed percentage. So variable here, fixed here. Now you come first as a preference shareholder, as a preferred stockholder. So you come first. If the company's going to pay a dividend, they've got to ensure they pay you first before they get to these guys. If they don't want to pay a dividend, they're not going to pay it to anyone. But if and when they work out the calculations, they need to make sure they secure this first. Now, God forbid a company fails, because companies can fail. Yeah? You, as a preference shareholder, could, and this is a real, light could, you could receive something back, maybe. But there's a whole lot of people to pay before you. They're called the creditors, the banks, the bondholders. They've already been paid off first before they get down to these guys. But these would come first out of the owners of our company, the preference shareholders. And these guys next. Okay? So they're slightly different. So you've got a choice. What do you fancy? Do you want a fixed dividend that never moves? Or do you want a variable dividend that could go up nicely if the company is very, very profitable? You can see how these could therefore be priced differently. There's one other downside with a preference share, perhaps for some of us. Usually, no votes. It's not always, it's usually no votes. So these guys have got the right to attend the meetings. These guys usually haven't. There are circumstances when they can get the vote, but usually it's a no. But it's up to you. Why have you invested in this particular product? Because I want this. I want a say in my company, or I just want a cash flow from my company. Yeah? Any questions? Yeah, absolutely. Everyone could buy these. Doesn't matter, ordinary shares, preference shares, but you just need to know what you're buying into. And that's the whole thing about a lot of these investments. Often the market is open to everyone. It's just we've got to understand what we're actually getting into. When we don't understand that, then that's when the problems can happen. We've seen that, of course, over the last God knows how many years, and many years before that. So we've just got to make sure our clients understand what actually they're buying into. And this is the job that we present ourselves with when we're talking to clients. The explanation. The regulators these days are all over us, making sure that we will give them the full factual disclosure on all the products they're buying. Much as if you were buying a car, you want to know exactly what it does. If you're buying a DVD player, you need to know exactly what it does. And that's what the idea here is. Okay, now here's a toughie. Here's a nice little toughie. To the nearest 10%, what was the high to low as a drop in the Dow Jones Industrial Average, one of the indices we talk about most? It's obviously the very important one in the States, the Dow Jones Industrial Average, following the Wall Street crash. To the nearest 10%, please. What do you reckon it was? Wall Street crash. Let me take you back to the Wall Street crash. We've been referring to it a lot over the last few years, comparing the last horrible years we've been through to something similar to the Wall Street crash. This is when guys, and I guess some women, were probably jumping off the buildings going, that's it, world's over. So it must have been quite heavy. I'd suggest it's probably more than 10%. What do you think? Anyone brave enough to have a guess? This guy's got it. The green team have got it. Sorry to play there. 89.18 to be precise, percent. Almost 100% drop in the markets. Well, okay, this is going from the high point to the low point. This is not just on one day. All right, it wasn't as bad as that, although, of course, lots of people thought it was. It was the high to low. 89.18%. That's huge. That's huge. Continuing that theme, True or false? It's an easy 50-50. True or false? The largest daily drop in the history of the Dow Jones occurred in 1929, the Wall Street crash. The largest daily drop, that's what we're talking about, the drop in one day, it actually occurred, believe it or not, in 1987. Black Monday. Black Monday, yeah. Black Monday, the 19th of October. Ooh, very close, isn't that? That's eerie. Very close to today. Black Monday, October the 19th. It dropped by 22.6% in one day. That's pretty hairy, isn't it? The largest single daily drop in the times of the Wall Street crash, 1929, was 12.8%. So it's kind of like less than half. Well, no, it's just slightly more than half there. That occurred on, whoa, Monday the 28th of October. How spooky is that? What a timely course we're holding here. The 28th of October, 1929, daily single drop was 12.8%. So we've seen some heavy movements in these markets, heavy movements, the Dow Jones Industrial Average. Does anyone know what that's made up of, incidentally, Dow Jones Industrial Average? We talk about it all the time. You go out and have a look on the screens, and the Dow Jones is always banging around there, isn't it? It's been around for a long time. Anyone know how many companies are involved in the Dow Jones? It is 30. It's actually 30. So that's the back right. Take a mark there. Back right. It's actually 30 companies. Now, this is an index we talk about all of the time. It's only got 30 companies in it. Is that really a kind of good reflection over the entire US? Of course it's not. It's just the 30 big companies. But yet we talk about it an awful lot. And you could see how some of these indices are, you know, really kind of worthy of talking about, and some maybe are not. Just 30 companies. It's just really reflecting the big, huge companies out there. It's a bit like our FTSE 100 in the UK. Yeah? Okay. So that was a mark for the back right. So we made up our marks there. Here we go. Let's go to the bond world. Which is riskier, government or company corporate debt? You're both right. Because you can't just say government is less risky than corporate, nor could you say corporate is less risky than government. It does depend on who we're talking about. If we're talking about Her Majesty's government in the UK, oh yeah, absolutely, default risk-free. If you're talking about the Fed, if you're talking about the German markets, the French market, yeah, a lot of those are default risk-free, as we call it. Because don't forget, a lot of governments, a lot of countries can also print money when they get themselves into trouble. We call it quantitative easing these days. But that's not the case with all governments. You've only got to think about Ireland, God bless them, Greece, Spain, Italy, and those countries that have suffered and are still suffering to this moment. So, you know, there are companies out there, believe it or not, that have a higher credit rating. Welcome to Fitch. You have a higher credit rating in comparison to some of the governments out there, believe it or not. Some big corporate entities, they're just less risky. So it's an awkward question. And that's why, of course, we have to break these things down further. That's why you're paying the guys big bucks to make sure they understand the differences between these. So it's not a final conclusion to the conversation. It's just the opening start. Why do we think this? So sometimes it is true that governments are less risky. In a lot of ways, the main governments, yes. But in other governments, perhaps not. Right, this is a bidding round, okay? So I want you to be brave, and I want you to tell me how many, seeing as we're talking about risks, how many risks you can mention. All right, so if you think you can mention 4, say I'll bid 4. If someone says I'll bid 5, then we'll throw it over to them. Whoever is the winner is going to take the mark. So start your bidding. Step up to the plate, what do you got? Credit risk.
Market risk.
Market risk.
Operational risk.
Operational risk.
Country risk.
Country risk.
Liquidity risk.
Liquidity risk.
Institutional risk.
Institutional risk.
Regulatory risk.
Regulatory risk. Oh, I'm liking these. Yeah.
7.
That's 7. Wow. That's pretty good. So we had credit, we had operation, we had markets, we had country, we had liquidity, we had institutional risk. Yeah, I'm pretty impressed with those. Did you have any others than those? Okay. So there's another one, reputational risk. The people risk is another way, I guess, we could be expressing operational risk. So again, we could play around with these terms within our individual organizations. You know, you can talk about credit risk. You can also talk about it in a lot of ways in the same kind of way as default risk. Inflation risk, interest rate risk. What was that, the last one? Conduct risk, again, kind of operational-ish. Vast area operational risk, isn't it? A lot of operational risk out there. The problems we may have, we talked about regulatory risk here as well. There is something that a lot of banks have been talking about, and this kind of arbitrage risk, or not arbitrage risk, so to speak, but kind of the ways that we could play off into certain risks against others. If we feel that things like these new regulations like Basel III and everything like that are requiring us to cover these risks, they might only mention certain risks. They'll say operational risk, you've got to cover this, you've got to cover this, you've got to cover that. If we find something else that we could kind of put ourselves into, and that's what a few of these banks have been doing, then it's less regulated. So it's almost like you're trying to do a regulatory arbitrage, if you will. You're trying to go between these differing risks. But the problem with that is, we've done that in the past. When we've been presented with rules and regulations, we've tried to work our way around those rules and regulations. We do this to try and make money for our shareholders, for ourselves. But the problem with that is, if you try and get outside the rules, you're going to create more problems. So who knows what we could face the next time around. We keep going through these crises, and who knows where we could be the next time. But it's all about these risks. Anyone else got any other risks? I jotted down a few. I had counterparty risk. Did you mention that one? You know, if we're dealing with a counterparty that could fail on us, that's why a lot of our products these days are running through what we call a clearinghouse. And that clearinghouse will make sure that all counterparties will honour their obligations. And we do this through collateral. We take margin. You've heard all of these terms, no doubt, before. So we put money down. It's like a deposit if you were renting an apartment. You give your landlord a deposit, and that covers him in case you decide to abscond in the middle of the night, or in case you decide to have a drug-fueled party in the apartment and wreck everything. That's what that deposit's there for. We have something similar. It's called margin. It's called the taking of collateral. All of those terms, perhaps you've heard. Yeah. So counterparty risk, FX risk. We could have gone for FX risk, couldn't we? If we have that FX concern. Yeah, but all of the others, pretty good. And I'm sure we could be here until, you know, this time tomorrow, perhaps, naming all the other kind of risks. But you can see, of course, that you have blends of these names as well. So what you call people risk, someone else might call something different. So again, it's a confusing way that the markets work. We could talk in all of these different ways. What's a gilt? A UK government bond, why do they call it a gilt? Does anyone know? It's because it's issued by a premium quality issuer. It's the UK government, who have never formally defaulted on any of their borrowings. Note the word I slung in there, formally. So to prove that point, back in the day, and I'm talking a long time ago, they had a lovely bit of bling around the outside of the certificate. You'd buy a certificate which had a lovely gold edge, a gilt edge around it. And that denoted you had something very special. It's not always the case. Not all gilts were issued with a gold block around it. I've got some gilts down in my desk downstairs, and none of them have got the gold. So just a regular certificate. But that's why they call it the gilt edge market. Who issues the gilts? Debt Management Office. Whoa, straight in there. Lots of people say, as it is in other jurisdictions, that it's the central bank. This kind of is. Keep it quiet. Don't tell anyone. Got it being recorded here. It is essentially the central bank. But back in the 90s, when the Labour government came in, they wanted independence in, of course, the creation of these government bonds to finance the government's debt, the country's debts. And it used to be done by the Bank of England. Now, I was a gilt edge market maker back in the day, and I used to talk to these guys on a daily basis. Apparently one day they came in and they found boxes by their desk. What does that mean to you in the banking world? When you walk in, you find a box by your desk. Yeah, you've normally got a security guard standing behind you as well going, can you just pack up quite quickly? I need to escort you out of the building. That wasn't what was happening here at the Bank of England. What they had to do is pack up their pencils, their rubbers, their rulers, their calculators, and they were being moved down the road about half a mile. They'd found a lovely premise between a gentleman's outfitters on one side, a curry shop on the next, and they were going to move in there. And of course, as you would do, they said, what's my new job? No, there is no new job. It's the same old job. You're going to be issuing gilts. except you won't be doing it under the title of Bank of England. You'll be called the Debt Management Office because we need someone independent. So they're an operationally independent body. It's called the Debt Management Office, but essentially made up of the people that we had at the Bank of England. Bit like when we change regulators. We don't sack everyone, we just change letters. Yeah, that's what we do. But that's who issues them. Okay, here's an interesting one. If you own a bond, do you want the yield, the return, to increase or decrease? Be careful how I use that terminology, return. But a yield. You own a bond, do you want the yield to go up or down? You want it to go down, so you want your yield to go down.
The way you phrased it.
The way I phrased it? Yeah, yeah. Now, does that sound counterintuitive? I have bought something and I want its yield, which another person could describe as a return, to go down. But you are exactly right. Yeah, you want it to go down. Let me just give you this. I'm not going to go through the maths behind this because that's going to be just boring as hell. Try this. If I gave you £100 to buy a bond, and that bond is going to pay you £10 a year. That bond is therefore yielding you, again, not an advanced maths lesson here, but that is yielding you 10% per annum, isn't it? Yeah? So there's your yield. So your yield is 10%. You paid £100 for this bond, it's paying you £10. That's like putting the money in a bank account. Exactly like putting your money in a bank account. That is yielding you 10%. Imagine if you could buy the same bond, but for only £50. So £50 buys you that £10 per year. That's a yield of 20%. You own this bond, you've bought this bond. What do you want to do in terms of the yield? What do you want the yield to do? To go down, not to go up. Because if it goes up, it means you just lost 50 quid in this example. So you can see there's this kind of inverse relationship between yields, interest rates, basis points, and bond prices. That's what it's all about. So yeah, when you actually own the bond, if you don't own it, then great. Yeah, interest rates going up would be fantastic, you can buy it cheaper. But when you own the bond, you don't want its value to go down. Almost sounds counterintuitive when you hear these people talking about it, but that's what it's all about. The yields are working inversely to the prices. Okay, here's another one. If an investor was quoted by a broker a two-way price, a bid, where you can sell, an offer, 52.53, and this investor decided she wanted to buy, what price would the investor pay? Quizzy Rascals. 53, yeah, 53. You're going to have to buy where someone is offering. And that's how these markets work. Believe me, when we do our courses, we do lots of these courses, and for lots of people, that's sometimes a very difficult concept. Just the buying and selling price, because it's confusing. You've got to think about what you're doing up against someone who's actually making the price. But in reality, it's quite simple. If you needed to buy a car, you've got to find someone offering you to sell a car, or someone to offer to sell a car. If you want to buy a house, you've got to find someone who's willing to offer a house. And that's the way you think about it. And the offer is always on the right-hand side. If you wanted to sell, you'd sell at 52. If you want to buy, you buy on the higher price. There's an even simpler way to think about this, to keep it, and this is the way I explain it to my grandmother. I say, Granny, just be aware of one thing. In any market you can mention, it could be property, it could be equities, it could be bonds, it could be FX, you will always be ripped off. You're always going to get the worst side of the quote. You want to buy, you'd love to buy at 52. You can't. You have to buy at 53. So you're always going to get the worst side of the quote. So if you're ever thinking about bids and offers, just always look for the worst side. Yeah? What costs more? A futures contract or an option contract? What costs more? An option. Why? You have to pay a premium. I like that. So what do you pay for a future? Don't know. Nothing would be a great. Yeah, it is an option. Option is the more costly, all right? The cost is the premium. We have to pay a premium. We have to pay a price for the option. The option is a choice. So imagine this choice I'm going to give you today. Let's say I have a house. Let's say I have a house. It's worth currently 500,000. Let's say I've got a house, it's worth 500,000. I will sell you a choice. I'll sell you the right to buy this house at today's price, and you can think about it for the next 5 years. That's pretty valuable, isn't it? If you have a belief that the property market's about to soar, if 5 years' time it's worth 5 times as much, you can buy it at today's price. Now that's worth something. That's the premium. So there must be a cost to that. The future, well, today we don't pay anything. What we do is we pay in the future. So futures contracts, unlike this choice, this right, this option, the future is all about I will buy something from you, or I will sell something to you, and that's of course at a future price, but we pay that in the future. That's a bit risky though, isn't it? When you think about the likes of Lehman Brothers and MF Global and all the problems we've had with some organizations, that's a bit risky. I promise you I will pay you the money in the future. How many times have you heard that from people? Lend me this money, please, and I promise you I'll pay it back. You go to claim the money back, and they're gone. They're disappeared. They can't afford to pay it. This is someone promising to do something in the future. That's so dangerous, isn't it? So I'm not too sure I like the futures market. I think it's a bit too risky for all of us. It's not, because we centrally clear these products. We go through, once again, the clearinghouse. And what the clearinghouse is going to do? Take that deposit, take that money, take the margin, take the collateral. So you know what? When you say you will do something in the future, you will do something in the future, because otherwise you've already paid for it. So it's kind of, you're going to do what you say you're going to do. So whilst it might sound difficult, it might sound complicated, it's not really. There's a choice. That's a definite. That's an obligation. Right. It's a bit more of a complicated conversation that we can have here, but very, very quickly. If I said to you, you can buy my house for 500,000 in 5 years' time, back to that original example, how do you think I would price up that choice, that right, that option? What do you think would be involved in the process? Yeah, okay, all right, but what do you think? Just think logically. Why would I do that? If perhaps I thought the property prices were going to go down. Yeah, I didn't think the price was going to go up, so I have the contrarian view to you. So it could be that. I could also see how the pricing or the property market is working at the moment. So I could see the volatility of the current markets. Now this is what we do. When we try to work out the premium, we have to think about the underlying asset. We have to think about the shares, the houses, the cars, the bonds, or whatever we're doing to these options. And we look at history, and that's the folly of this. That's the danger of this. Because we look back, we do a bit of linear regressions, they call it. We look back and we see how prices have been moving. Now imagine if you had house prices over the last 20 years, literally just doing that, just staying around an average. So almost you could predict where it's going to be there, because it's going to follow that line. But imagine if house prices were constantly doing this, up, down, up, down, up, down. I wouldn't have a clue, and perhaps you wouldn't, in terms of where the price would be from one day to the next. That's volatility. And if something's going to be volatile, I'm going to have to charge you a lot of money because I'm unsure. If we're unsure, the premium is going to be very, very high. So involved in that premium is going to be my prediction, I guess, in terms of how the volatility, what I think that volatility is going to be over the next little while, where I think the price is going to be. If I'm absolutely certain it's going down, then maybe I could do this. It's going to be about how much time I give you. Because I could give you this option for the next 5 days. You've got to have to think about it in the next 5 days, not 5 years. That will change the cost of the option. So all of these things, all of these factors get put in, and we have pricing models like Black-Scholes and things like that that would actually give us the premium. So it's, in a nutshell, we put all the factors that can affect the price of the underlying asset into a model to come up with the premium. But it's all about probability. It's all about likelihood. An easier way to explain it, car insurance. Don't know if anyone's taken out car insurance over the last little while. You normally renew it every year. But if you take it out with a new company, what do they say? How old are you? Bit rude? How many years you've been driving? How many accidents have you had? What the hell are they after? How many accidents you had? How many speeding tickets? They just get so intrusive with all these personal questions. But what are they asking those for? To work out the premium. To work out the likelihood of you using that contract. Not an option, an insurance contract. So if you turn around and said, I'm 18 years old, I've been driving for 1 year. I've had 10 cars. 5 of them are wrapped around lampposts down my local high street, and the other 5, I don't know where they went. They've just disappeared. Someone's nicked them. Yeah. I've got speeding tickets the length of my arms, and by the way, I want to insure a Porsche. You know, what do you think the premium is going to be? It's going to be sky high. It's all based essentially on probability. What is the chance of you getting to use this contract? And if it's high, I'm going to charge you a lot of money. If it's lower, we can have a chance. Okay, what is a swap? Two counterparties swapping cash flows, yeah? Okay, so we've got a derivative, which means it's a contract, an agreement that derives its value from something else. Yes, I go with that one. That would be true. Swapping cash flows, that would also be true. Any other advances on that? Could be a fixed or floating rate, yeah? Yes, you're right. It is a contract. It is an agreement to swap things. Now, it doesn't have to be interest rates. That's what I was looking for. It doesn't have to be interest rates, but the largest of the swap markets does, of course, talk about interest rates. It's interest rate swaps in those ways, okay? So interest rate swaps, the largest of markets. I'm not going to give you too many clues because we're going to start bidding again. How many other swaps can you mention? Start your bidding. 6, a late 6. Nobody's going to beat 6. Let's go for it, Quizzy Rascals. What have you got? Interest rate swaps. Gave you that one. Currency swaps. Okay. Total return, like that. Asset swaps. Volatility swaps. Mortgage-backed swaps. Okay. And that's 6, isn't it? Yeah, okay. Nice. Any others? Did you have any others that you were thinking of? So what we had then, just to remind you, is an asset, a volatility swap, a cross-currency swap I'm going to go for here, an interest rate swap, a total return swap, a volatility swap, and a mortgage-back swap. Any others? Okay. Other ones I thought of, the kind of reverse of an asset swap, when our companies are going out there to issue debt, they're trying to please everyone. Go on. Credit default swap. Yes, CDS, a credit default swap. Bit like insurance that we were talking about a moment ago. If you want to insure yourself against losing the cash flows on a particular asset, credit default swap. Yeah, okay. So where were we? Had asset swaps, volatility swaps, cross-currency swaps, interest rate swaps, total return, mortgage back. Do any of these terms actually mean anything to you? Anything? No. No, okay. An interest rate swap, just think of it very, very quickly. They're a swap of cash flows. One is going to be a floating cash flow, the other is going to be a fixed cash flow. What do you think is going to be the next move on interest rates in the UK? Which way is it going to go, up or down? Up or down? Up, yeah? Everyone consistent with up, okay. When is a difficult question. So when are they going to move? I mean, it's been changing over the last week alone. We've been thinking about when the timing of the first rate hike is going to happen. If you guys are on a variable rate mortgage, are you thinking, are you being nervous at the moment? Are you getting a bit worried about interest rates going up? Are you worried about the cost of your mortgage increasing? What could we do about it? Fix it. Interest rate swap. What you can do, if you don't like your liability, you could literally fix it. So you could be paying a fixed amount on a cash flow and receiving in a variable amount to sort of kind of hedge your bets, if you will, or cover yourselves. Yeah? That's what it is. That's what an interest rate swap is. You're going to agree to pay a fixed rate and you're going to swap it for a variable rate. That's what you're doing. So effectively, you're locking in. Just very briefly, again, I don't want to bore you with this, but imagine this. This is us, and we've got a mortgage. The mortgage is on a variable rate. Okay, there's your mortgage. Now, you're worried, as we've just said, that interest rates could go up. Well, this vehicle, if we were allowed to use it, it's tending to be for the professional markets, of course, but you could do a swap. Now, let's say what you want to get rid of is this horrible variable rate risk. Yeah, it's on a variable rate. You're worried about it getting more and more higher in terms of your mortgage. So what you would do is you would agree with the bank to pay a fixed amount. Yeah, a fixed amount. They will return a floating amount, a variable amount. Well, just imagine this. Let's imagine that we perfectly marry up these two variable rates. Yeah, so let's say it's 3-month LIBOR. Yeah, your mortgage based on 3 months LIBOR, that's where we started this conversation, and these rates are both 3 months LIBOR. You've just kind of immunized yourselves away from interest rates going up, haven't you? Because if interest rates go up, your mortgage becomes more expensive, but you get more back in on the swap. And if we're talking about the same rates, that will offset that. So that just nets off and you end up paying a fixed rate. If rates go down, your mortgage gets cheaper, but you get less in on the swap and you're paying the fixed rate. It's exactly like fixing your mortgage. That's all it is. You are agreeing to pay a fixed rate. And if rates move, if you fixed your mortgage at, let's say, 4%, if rates went up to 20%, you pay 4%, right? If they go down to 2%, you pay 4%. And that's exactly this. So you hear all these terms and you often think, oh my God, that's really complicated. It's not. It's not. It's kind of things that we do on a daily basis in our own little way. So there's a version of an interest rate swap. They can get more complicated. We haven't got time to go into that right now, okay? The swaps we have, asset swaps, where you swap the cash flows that you get on an asset for something else. You can literally take the asset's cash flows and swap them. The other side to that would be a liability swap. Let's say a company comes to one of our banks. Company comes and says, right, I need to borrow some money through the bond market. If they were issuing a bond, they can issue it with a fixed rate, so a rate that never changes, regardless of what happens to interest rates, or a rate that's variable, that will go up or down with interest rates. What do you think the company would love to issue right now? So do they want a floating liability that will go up as interest rates go up, or do they want a fixed liability that never changes? What would they want right now? A company. Companies come to your bank and said, I need to borrow this money. What would you suggest to them? A variable rate loan or a fixed loan? Fixed. Right, okay, so the company wants a fixed liability that never changes, like us fixing our mortgage. What do you think investors want? Fixed? They want variable. So we've got a clash. And if you ever talk to anyone that's in your DCM department, your debt capital markets department, in origination, they will always utter these phrases such as, give the market what it wants. Because if you don't give them what it wants, what they want, they won't give you what you want, that's capital, the money. So we have to try and find a way to square that problem, to clear it all out. How we do it is with a liability swap. It's just an interest rate swap where you help the company to get their needs and the investors to get what they want. So that's a straightforward thing. So again, a lot of these terms may sound complicated, but a lot of them are quite straightforward. What does it mean to short sell? To sell something you don't own. My grandmother once asked me that. She said, what do you do? What do you do on a daily basis? Now that is one of the most awkward questions you can ask anyone that works in a bank. Anyone that works in finance. Ask them that question. See how they squirm. What do you actually do for a living? Because my grandfather used to make furniture. He had his own workshop, he had his own lathe, he had beautiful things to show for his life. And there's my grandmother turning to me and going, what do you actually do? What do you actually do? And the only thing I could think of rather crass was, I make money. I make money. What, you print money? You print money, you print, that's what we get in our pockets. I said, no, that's what the Bank of England does. We call it quantitative easing, different subject. No, that's not what I do. I said, I just buy and sell things. So she said, you work on a market stall. And I was like, yeah, I guess we do. The banks work in a market. It's like working on a market store. It doesn't matter whether we're trading apples, it doesn't matter whether we're trading cars, property. That's what we're doing. We're just taking various different products. We can jazz them up. We can make them sound all flash by using terms. But essentially, that's what we're doing. We're trading in a marketplace. We buy and sell things to try and make ourselves money. I buy cheap, I sell high to make a nice little profit. And I said, yeah, okay, I agree. That's what I'm doing. I work on a market stall. So she said, tell me your typical day. Oh, imagine someone asking you that. What's your typical day? You're going to sit there thinking, oh, I don't know. So I said, well, I woke up and I was feeling very bearish, Granny. And she just looked at me. There's a term, bearish. We use it in finance to mean we're negative. And she just looked at me. She said, what are you talking about animals for? I said, no, it means we're negative. And then a comment only a granny can say that levels you down to the size of a gnat. She said, why didn't you just say that? Because I'm trying to be flash. No, it wasn't that. It was just the terms we use. We throw them around like they mean something, but they don't. And I said, okay, feeling negative, bearish about the markets. She asked me what I would say if I was feeling positive about the markets. I said, bullish. Yeah, moving on. That was the conversation. So she said, right, so you're feeling negative, sorry, bearish. What did you do about it? I said, I shorted something. What does that mean? What does it mean to short something? What does it mean to go short? And I said, I'm selling something I don't own. Her eyes lit up with pure anger. She said, that's criminal. That's absolutely criminal. You sold something you don't actually even own. It's like me saying to you, I'll sell you a car. I've got this car over here. It's not there. And I'm going to sell it to you. That's what she thought we were doing. And that's exactly what we kind of are doing. We're selling something that we don't own. But we are going to get it back. We are going to get it back, hopefully at a lower level. So I'm doing the reverse of what I just said. I'm not buying down here and selling up here. I'm going to do it the other way around. I'm going to sell up here and go buy it back down here. So I sell something in the anticipation it's going to go down and I can pick it up cheaper. It's easy. But she still thought it was criminal. She said, how can you sell something you don't own? Surely you're promising someone that you will deliver it to them. We said about spot rates. We said in 2 days' time, I have to literally come up with the goods. So how can I promise someone that I will sell them something in a couple of days, I'll deliver it to them in a couple of days and I don't even have it? Well, that's when the markets really come into play. We can borrow things. We can do things like repos, where you can actually just get that product in. You can borrow that product by lending them out cash and getting the deal that way, get it done that way. So we don't fail on delivery. We don't have reputational risk. We don't lose anything there. We basically, can do these things. We can do stock borrowing and lending. If I sell some shares that I don't own, I just contact one of these brokers who will find someone that's holding onto these shares and doesn't need them for that particular moment in time. I'll pay them a fee, they give me the shares, everything's happy. So that's how we can do these things. But it is rather negative in its approach, isn't it? I'm going to sell something because I think it's about to collapse. It's going to go down. And that's why the regulator sometimes doesn't like us doing these kind of things, because it is rather profiting on people's downfall. But that's short selling. We can do these things. We create these procedures in order to open up the market to everything we want to do. So even though we could cover loads of terms today, in a couple of weeks' time, we'll have a load more terms because they just keep changing. They keep changing because we create and we innovate. And that's the beauty of banking. It just keeps growing, keeps changing. Sometimes it's forced change because we get all these regulations heading our way and we've got to try and work out a way to work within the regulations. Not work outside of them, but work within them. Ooh. What's that a graph of? Now, bear in mind, if your eyesight's not as good as mine, and mine's pretty terrible, this goes down here to 1920. 1920 all the way up to 2014. What is that asset? What asset didn't seem to suffer like the other assets over the last 7, 8 years? Just seem to be rising. From this point here, this is 2005 to 2009. So that's right there in the midst of the credit crisis, the collapse of Lehman Brothers. And yet this asset just kept going and going and going. It's only recently sort of come back down. What do you reckon that is? On your buzzers? Okay, it was gold. Now, over the horrible times that we've just experienced, and hopefully that's kind of the end of it for a little while at least, although it did give people lots of opportunities, we saw all markets collapsing. Bonds went down. Exchange rates, went kind of weird. Equities went down. Interest rates went down. All of those things just collapsing around us. Property kind of got hit, except for certain areas. All of these prices just fell, with the exception of some of these commodities, and in particular gold. Now, the problem we have is if you're running a massive fund within your organization, or you're part involved with one of these funds, we couldn't just change the products that we are currently involved in. You can't just say, I'm running an equity fund, equity's about to fall, I'm going to get rid of all of those and buy gold. Well, then you're not running an equity fund. And that's the problem. We often face these kind of situations in the markets where we just have to do the best we can possibly do. Or perhaps short sell. Or perhaps use a future or an option to give us the ability to make money even when the markets are going against us. That's why we blend these products together. Okay, name the respective heads of the European Central Bank, the Federal Reserve, and the Bank of England. If you can only name one, then Press the buzzer and say 1 or Mark Carney. Okay. So Mark Carney for the Bank of England and their respective policy rates. What would it be in the Bank of England? That's 0.5%. That's the Bank of England base rate. The Bank of England base rate set by the MPC, the Monetary Policy Committee of the Bank of England. They look at what's going on in the economy and they work out when and if they want to move rates. Currently, Mark Carney and his members of the MPC have it set at 0.5. Okay? So we've got the others still open. So ECB and the Fed. Sounds like, okay, if anyone is a film buff, it sounds like an opponent of Rocky Balboa in one of the Rocky films, but it's not. Mario Draghi. Last move was September the 4th. Sorry? 0.75? No, not 0.75. Last move was on the 4th of September, so it's quite recent. What's happening in the Eurozone right now, guys? What is happening? Are they having a good time or a bad time? You've read the press, you hear this talk going on in your banks. What's happening in the Eurozone? Now, if we are worried that our economies are collapsing, we tend to lower the interest rates to make money cheaper to hope that the citizens will buy themselves out of this horrible time, to buy themselves out of recession. That's what we did during the credit crisis. Banks around the world slashed their rates. So we've got this rate at the ECB, which we call the REFI rate. And what do you reckon it is? It's not 0.25. It's actually 0.05. 0.05%. It's practically zero. Practically zero. So that's Mario Draghi, and that's 0.05. The last one there, all of you girls in the room should be ashamed of yourself. Green team.
Janet Yellen.
Perfect. Yeah. Janet Yellen. She's head of the Federal Reserve, of course, out there in the States. And what is their rate called? 0.25%. I'm going for that, but what do they call that rate? That's correct, but what do they call it? Target rate. Target rate. Good. Okay, guys. I did have this there. Now, what I'd like to do is, obviously, we're not going to carry on because you guys are either getting bored or you've had enough or you want to get another sandwich or something like that. If you have any further questions, please, I've got my card up here, but just drop me a piece of paper here and say, when you have a moment, can you just explain this further to me in any way? That's what we tend to do when we're doing our courses. You know, we have lots of people in there from different backgrounds, different academic backgrounds and all of those things, and we go through lots of different areas. Some people pick it up very quickly, others take a little while time to sort of chew over the information, and what we always do is we leave it open for these guys to come back to us. So every course we do, we give out our emails, personal mobile phones and all of this, and we still talk to people that have been on grad programs from years ago. And it's nice because we keep the knowledge going around in the markets, okay?